uncover the hidden cause behind the current banking crisis that's shaping our financial landscape. In 2008, the financial markets witnessed a devastating crash that changed lives worldwide. Few understood the underlying cause at the time, which was the emergence of mortgage-backed securities. Fast forward to 2023, and we now face an even greater threat: the commercial mortgage-backed securities market. In this video, we will explore the significance of CMBS, how it will shape your life and finances, and why it is crucial to pay attention to this looming crisis. The CMBS market. The CMBS market, which stands for Commercial Mortgage-Backed Securities, is set to revolutionize the way we live and handle our finances. While most people remain oblivious to its implications, I've been warning about the potential disaster brewing in this industry for the past 2 years. This crisis has been unfolding quietly on Wall Street, yet it is expected to make headlines in the coming year or two. Understanding CMBS. To comprehend the potential severity of this crisis, we must first understand what CMBS is. Commercial mortgage-backed securities involve multifamily mortgages and are distinct from residential real estate-backed securities. The unique nature of the underlying property assets makes CMBS more complex and volatile. These assets encompass large apartment complexes, local retail centers, and other commercial properties like grocery stores and strip malls. Factors leading to the crisis. The CMBS market is currently experiencing a massive blow due to rising interest rates caused by the Federal Reserve's measures to combat inflation. As the interest rates soar, investors with debt tied to these assets face immense challenges when attempting to refinance at much higher rates. Additionally, the global pandemic caused widespread economic disruptions, with businesses shutting down and people unable to pay rent. Consequently, numerous commercial properties remain vacant and unused, compelling companies to shed unnecessary expenses, including empty office buildings. Excessive risk-taking by financial institutions. Excessive risk-taking by financial institutions is a common factor that contributes to such crises. When banks engage in risky lending practices or investments, without adequate risk management measures, they become vulnerable to potential losses. This overexposure to certain sectors can erode investor confidence, prompting a sudden loss of faith in the institution. Impact of non-performing loans. Another significant factor is the presence of a large number of non-performing loans. When borrowers default on their loans, it results in an increase in NPLs, which significantly impacts the stability of banks. The consequences reverberate throughout the economy, leading to a decline in economic activity and a rise in unemployment. Macroeconomic factors in banking crisis. Macroeconomic factors such as recessions, high inflation, or currency devaluations can also trigger banking crises. These factors adversely affect the financial health of banks, reducing their profitability and eroding investor confidence in the process. Regulatory and supervisory failures. Regulatory and supervisory failures are another contributing factor. Weak regulations, inadequate oversight, and a lack of enforcement create an environment conducive to risky behavior and fraudulent activities within the banking sector. Such activities can ultimately lead to the collapse of financial institutions. Challenges in the CMBS market. The CMBS market presents several downsides, including limited autonomy in property operation, inflexible loan terms, and difficulties in releasing collateral. Exiting the market can also prove expensive, as seen in cases where large conglomerates like Blackstone have walked away from properties, resulting in significant haircuts to the original agreements. Furthermore, more pension funds are attempting to pull out of commercial real estate investment trusts, signaling the expanding scope of the crisis. Impact on your wealth. Although you might not directly own commercial real estate, it is essential to understand how this crisis will affect your wealth. Silicon Valley Bank and First Republic Bank, for instance, hold toxic assets in the form of REITs or CMBS. As these banks continue to collapse, the repercussions will be felt throughout the financial system. By staying informed and following those who have warned about these issues ahead of time, you can better navigate the situation. Lessons from the past. The parallels between the current crisis and the Great Recession of 2008 are striking. Mass layoffs, plummeting stock markets, and rapid declines in home values are recurring themes. It is crucial to take an active role in understanding and monitoring these markets and their seriousness. Accumulating debt is ill-advised in these times. Instead, focus on eliminating debt and consider investing in inflation hedges like gold, silver, and potentially stable cryptocurrencies like Bitcoin. However, even cryptocurrencies are susceptible to the derivative implosion triggered by stock market sell-offs. Preventive measures to avoid banking crises. In order to prevent banking crises, it is crucial to implement preventive measures that can help maintain the stability and integrity of the financial system. Here are some key measures that can contribute to the avoidance of banking crises. Strengthening regulations and supervision. One of the most effective ways to prevent banking crises is by establishing and enforcing robust regulations and supervision. Regulators play a critical role in overseeing the activities of financial institutions and ensuring their compliance with established rules. By closely monitoring the banks, regulators can identify potential risks and take necessary actions to prevent them from escalating. Minimum capital requirements are set to ensure that banks have enough capital to absorb potential losses, making them more resilient in times of economic downturns. Enforcing risk management practices is also crucial, as it ensures that banks are aware of their exposures and can effectively manage potential risks. Promoting sound risk management practices. Banks must adopt sound risk management practices to avoid excessive risk-taking, which is often a root cause of banking crises. Ensuring that loans are made to creditworthy borrowers is crucial in maintaining the quality of assets held by banks. Diversifying the loan portfolio helps mitigate concentration risk and reduces the impact of potential defaults in any one sector. Regular assessments of the creditworthiness of borrowers help banks identify potential problem loans early on and take corrective actions to avoid future defaults. By proactively managing risks, banks can significantly reduce the probability of facing financial distress. Encouraging transparency and disclosure. Transparency and disclosure are fundamental pillars in preventing banking crises. Banks must provide accurate and timely information to stakeholders, including investors, regulators, and the public, about their financial condition, risk exposure, and risk management practices. Transparent reporting enables stakeholders to make informed decisions and hold banks accountable for their actions. This, in turn, fosters confidence in the financial system and reduces the likelihood of sudden loss of faith in the institutions, which could trigger a crisis. Fostering a culture of ethical conduct. Maintaining a culture of ethical conduct is paramount to preventing banking crises. Banks must promote ethical behavior among their employees and discourage any unethical practices that could jeopardize the stability of the financial system. An ethical culture ensures that banks prioritize the long-term well-being of their customers and the broader economy over short-term gains. By maintaining high ethical standards, banks can build trust with their stakeholders and help prevent actions that may lead to systemic risks. In conclusion, understanding the causes of banking crises empowers us to take preventive measures and safeguard our financial systems. By implementing measures shared in this video, we can enhance the stability and resilience of our banking sector. Stay informed, stay vigilant, and be an active participant in creating a more secure financial future. If you found this information valuable, don't forget to like this video and subscribe to our channel for more insightful content. Together, let's navigate the complexities of the financial world and build a stronger, more resilient economy.